All right, here's the agenda for tonight. We're gonna go over a little just Old Capital introduction, go into a little bit of a lending update, go through some recently closed deals that Old Capital has completed, and then we'll bring Jilliene in and chat with her for a little bit. So we had 400 people register, and so I had 400 questions to consider, and I boiled that down to a more manageable number. So hopefully we can get some good answers from her on that, and then we'll have some virtual networking after that. So let's just a little intro about Old Capital. So Old Capital is a mortgage broker based here in Dallas. We have a team all across the nation. Clay's out in Atlanta, Julie and Dave are out in California, and then we have people in sort of all the major metros in Texas, and we do about $1 billion in multifamily financing, mortgage brokering a year. So we stay pretty busy. If you haven't seen any of our sort of social podcast conference stuff, we have a podcast we've been doing for about 5 years. We get about, I don't know, 50,000 downloads a month on that. We do a conference once a year. This past year was virtual. And then you can look for us on Facebook, YouTube, where we do different videos and things like that. So I wanted to give just a quick lending update and what we're seeing in the market right now, sort of around Fannie, Freddie, and non-recourse bridge. So I brought up this example of just a $30 million deal, let's say in Dallas. Most of the deals right now, because of sort of where 10-year treasury has run up, we're seeing Fannie quote probably about 70% just based on debt service constraints. Freddie, depending on sort of your sponsorship level, they are probably 65, 135 if you're inexperienced, and I have a quote up to 75% if you have a little bit more experience. But the thing that really has changed probably in the last 2 to 3 months is really non-recourse bridge. So non-recourse bridge has come in. They're anywhere from 75 to 80% of purchase price, 100% of rehab, and some of them are even going up to 85%. And their rates have come down significantly. So they were in the fives. Now they're, LIBOR plus 300, 325, depending on the quality of the asset in the market that you're into. So we've seen that change pretty dramatically. And so Fannie and Freddie, we're seeing adjust their reserves. So they had reserves when COVID came out. And so Fannie has come out and said, if it's a stable deal, we're seeing reserves eliminated if it's lower leverage. And then if it is not, let's say it's 75, 80%, we're doing 6 months IO. So a little bit better. And then just a couple of weeks ago, Freddie Mac came out and said, all right, we'll just do the same thing. So they're at 6 months on acquisitions typically, and 9 months on refinances. And most of the time that's interest only. So I thought that was pretty interesting in terms of where the market is and where we're seeing. So I would say in Q1, in terms of recent closed deals, we'll go through some of these, but I think at our next meeting, what you'll see is that the shift in the types of deals that we will have closed is going to be different. So, but just in the last month, these are some of the deals. Clay closed this deal out in Bradenton, Freddie Mac SBL deal, duplexes on 59th. Paul did a acquisition loan, Fannie Mae, 75% LTV, 4 years IO, out in Sanger, which is sort of northwest Dallas, north of Denton.
Leave it.
Yep.
Yeah.
If you guys could mute yourself, that would be appreciated. Thanks. And then Villas at the Park was a Fannie Mae refi from a bridge loan that we did recently here in Arlington. Cooper Park was the loan assumption that we helped the client with. Village condos. So this one actually was non-recourse bridge. It was a broken condo that the borrower was actually buying the remaining units. And so we were able to put that deal together with 3 years IO. And that was Hans down in Austin. This is another Freddie Mac SBL deal in Pleasanton, Texas. And then Dave closed 2 Freddie Mac conventional loans out in Corpus Christi. So that was Indigo Apartments and then Latitude Apartments in Corpus Christi. And then Hans actually did a retail deal. So retail is still out there. So sometimes we'll get called on to do other commercial types besides multifamily. So this was 70% LTV recourse. And then Henry just closed a self-storage deal in Austin as well. So that was a recourse bank loan at 70% loan to cost. So I think what you'll see is a lot of Fannie and Freddie in the first quarter, a lot of the pipeline that came through, and then what we're going to have, I think in the second quarter is a lot of bridge. So get ready for that. But now that was all I had sort of for an intro, and I wanted to bring Jilliene in and start firing away. And from all the questions that I got, it really boiled down to these four things. And I didn't know how a good way to put it on the slide, but really starting sort of a little bit broader with the outlook, sort of commercial real estate, what you're seeing across property types, and then boil down to multifamily. So a majority of the people on the call are going to be multifamily investors. So I want to spend probably 5 to 10 minutes on sort of all of commercial real estate, deep dive into multifamily. And then the second half of the interview, I want to spend on equity and what you're seeing on equity and what you're seeing from your investors and what they're wanting. And then the last sort of 5 to 10 minutes, talk about Realty Mogul and sort of how you guys have structured your deals, and get into as many of those nuances as we can, since we have you here. And I have a lot of questions. Any question that you can't answer, you can just say pass, because we've got a lot of them. So if that works, Jilliene, are you still there?
I'm here.
All right.
Thanks for having me.
Yeah. So maybe just to give people, I've read about your background a little bit, but maybe to kick it off, give people a little bit of your background and then sort of why you started Realty Mogul.
Sure. So I'm the CEO of Realty Mogul, and we're a crowdfunding platform for commercial real estate. We have been involved in almost $3 billion of transactions. We should cross 3 billion either this month or next month. So we've done a lot of real estate deals over the last 7-8 years. About 65% of that has been in multifamily. So we've been investors in over 16,000 apartment units across the country. And we see a lot of deal flow. We've had over 30,000 transactions submitted to the Realty Mogul platform. We have funded to date just around 300 transactions. So not quite 30,000, but 30,000. And so we see a lot of flow, both in multifamily and in other asset classes: office, industrial, retail, self-storage, mobile home parks. And we are a marketplace for investors who are looking for passive investments in commercial real estate, and we pair them with investment opportunities. So if you go to the Realty Mogul platform, you'll see a variety of different real estate opportunities that you can sort of pick and choose from and build your own real estate portfolio. And I started my career in banking. So started in banking, learned a lot about regulation, learned a lot about financing, learned a lot about credit. I was involved in the acquisition of 2 banks, particularly on the real estate portfolios, worked in risk management at the bank as well, and then started Realty Mogul in 2012. And we really got started in earnest 2013, and then about 2015. I was worried about the commercial real estate market at that point in time. So little do I know that was an amazing vintage. If you had invested, 2012, 13, 14, 15, 16, 17, those are all going to be very, very good vintage years, in hindsight. But we've been slow and steady, right? And we'll do probably between 40 and 50 transactions this year. So a decently high volume of transactions, but we'll see, a couple hundred, if not, around 1,000 deals probably this year.
Yeah, it's funny. It's like we were joking on another deal that we were looking at, and it was like we should just bought everything in 2013, 14, and 15. So,
yeah.
But let's. I'm going to try to structure this around sort of CRE outlook and then just sort of multifamily. So I'm going to fire away with some questions here from the group. So Melanie asked sort of what you're seeing. Maybe let's start big picture market outlook for maybe the major food groups in commercial real estate, and then maybe hone in on multifamily a little bit.
Yeah, look, one of the things I love about real estate is that there's always opportunities, but that doesn't mean that you should be investing in all types of asset classes with all types of sponsors in all types of markets. But there's always opportunity, right? There's opportunity to do distressed stuff. There's opportunity to do performing assets. So I think that, strangely enough, this question really comes down to one's personal risk tolerance. I'm very bullish on multifamily. I continue to be very bullish on multifamily. Where interest rates has been incredibly helpful during this COVID period. I am concerned about interest rates starting to rise again, and what the impact that's going to have on multifamily if cap rates don't start adjusting. Right? If cap rates keep going down and interest rates start to rise, your return profile on multifamily is going to look very different. But I like multifamily because we still have a supply problem in this country, right? When you look back and you think back to the 2008 crisis, we were oversupplied in single family housing. And that was a big part of why the great financial crisis happened in 2008. We don't have that problem in multifamily today. So we haven't built enough multifamily, particularly workforce housing and affordable multifamily, where the economics don't actually make sense to build more of it. And there is a great dearth of supply of it. So I will continue to be bullish on multifamily until I start to see the metrics change such that we really do have enough supply of housing and we really do have enough supply of affordable housing in particular. I think though that returns are going to come down. So one of the things that we're grappling with at Realty Mogul is educating our investors to change their expectations. Right, in our 2014, 15, 16, 17 vintage, if you were going to go buy a value add multifamily deal, a lot of those deals have transacted. Investors got 17, 18, 19, 20% IRRs. So really, really strong returns. I don't think that's going to be the next vintage of multifamily, right? I think that if you can invest in a multifamily asset, depending on the level of CapEx required and the level of renovation, but let's just say, right down the fairway, kind of $5,000 a door, very standard value add deal. I would love if people were happy with a 13, 14% return. And I think that's probably where this next vintage is going to land, obviously, depending on the deal. And anything I say, past performance is not indicative of future performance, and don't make any investment decision on anything I tell you tonight, please. Do your own research and get your own advisors. But what I do think is that I don't know personally where else to put my money for that same risk adjusted level of return, right? I can go into stocks, I can go into debt. There's obviously a lot of places where I can invest my money and where, anyone on the call tonight can invest your money. But even if I'm able to generate a 13 or 14%, annualized return out of multifamily, I still, for myself personally and my personal financial situation, that's the best risk adjusted return that I know to find in the market. But I don't think that we're going to see the same level of returns that we saw in the last cycle and kind of the last vintage, call it 2013 to today, frankly. And the reason why is there is so much more money chasing this asset class today, right? It is a supply and demand equation, and there's billions and billions of dollars of dry powder sitting on the sidelines, including foreign capital, domestic capital, pension capital, individual accredited investor capital, and real estate, and particularly multifamily real estate, is no longer an alternative asset class. So when we started Realty Mogul in 2012, I think that real estate and multifamily was still an alternative asset class. I don't think that your average investor thought about buying a share of an individual property as part of a normal thing to do to build a diversified portfolio. And I think the mentality of that has changed quite a bit. I don't think real estate is truly an alternative asset class anymore. I think that there are, other alternative asset classes. So there's tremendous amount of demand for multifamily. I think that the returns are going to come down, but I still think that it's a good risk-adjusted return. So I'm bullish on multifamily.
Yeah,
Um,
I was watching an interview you were doing with John Seabury, and you were looking at a deal in Arkansas for a 4.2 cap. So you thought that was pretty aggressive still
Yeah, look,
on
it didn't
winning
make
that
any
deal.
sense, right? It didn't make any sense to be buying four caps in Arkansas, especially now with, treasuries gapping out another 10 basis points today and where rates have moved, right? I really like multifamily today where we can lock in long-term debt, or we can, buy something with a loan assumption on it with long-term debt. I'm struggling more today than I have in history of kind of our experiences at Realty Mogul with refinances, with a bridge debt to a refinance, because I just don't know where rates are going to go. And this coming from a person who, when COVID started, I wrote an article, and you can find it on our blog if you're interested, or, ping me or ping James. We'll figure out a way to get it to you. But I wrote an article about how, for the first time in my career and in my life, I thought there was a possibility we'd see negative interest rates in America. right? You've seen it happen in Japan. You've seen it happen in Europe. I was worried that the economy was going to get so bad that we might see negative interest rates. Now, the reality is that the Fed just pumped money, right? We
Right.
just pumped trillions and trillions of dollars of money into the economy. And what that did was it propped up the economy, right? And it created an environment today in COVID, during COVID, and sort of now, on the tail end of COVID, hopefully, that is very different than what happened in previous recessions, right? And so as a result of that, they didn't drop or continue dropping interest rates, right? And that being said, even when I had the belief that we may see negative interest rates and that interest rates may continue to decline, we were still locking in 10-year financing, fixed rate, right? And the reason on some of our investments, and this isn't true of every investment, but on some of our investments, the reason we were doing that was because the deal still worked. And so if I can have a deal work and I can lock in financing, it's just one less thing that I have to worry about, right? It's one less variable in the mix where I have to be concerned. And like, I don't care if interest rates go up or down, right? And I care because I care about our business, obviously, and I care about the opportunities, but there are decisions you can make in an uprising environment and in a downrising environment. It's just a slightly different strategy. We bought a deal in El Paso in May of 2019, so almost 2 years ago now, and our debt is in the high fours. And so you look at that today, and had we bought that deal, maybe 120 days ago, my debt on that probably would have been 325, maybe 320. And yet I don't wake up in the morning pissed off that I locked in 10-year debt in the high fours because the deal works, right? The deal works. It's cash flowing. It's got double digit cash on cash returns. And I've locked in the debt. And maybe your debt will go to 5%. Maybe it'll go to 6% over the next 10 years. I don't know. But I like that peace of mind. And I find that investors, well, predominantly a lot of investors are investing for retirement. I find that they like that strategy more. Now, that being said, I still like bridge debt. And I still like, value add business plans. We have another transaction where, we're renovating and it's a heavier renovation. It's $15,000 to $20,000 a unit. It wouldn't make any sense to put long-term fixed rate financing on that because the refinance, you're going to be able to pull out so much equity that it doesn't really matter how much interest rates aren't going to move enough in that time period, right? It's probably an 18-month renovation period. They're not going to move up, enough that calculation makes sense. So it's definitely a place for bridge debt. And I'm kind of jumping all over the place, but my market for multifamily, I like it because of the supply and demand fundamentals. But I think that this vintage, the returns are going to be lower for kind of all the reasons that I just talked about.
All right, that's perfect. Let me jump to a couple of these other ones to see if we'll sort of pick and choose some of these. So we hit multifamily. I think you like that. I guess one asked sort of around, sort of post COVID. Is there
Yeah.
any asset class that you've seen your investors sort of demand more? Obviously, multifamily's done well. Have you guys looked at industrial? Is there any other sectors that has seen sort of the demand peak?
Yeah, I mean, multifamily is the majority of the transactions that we do, based on kind of our belief on risk return profile. But interestingly, I'm going to share a couple of specific examples. We did in the really so the deals to be had in COVID were in Q2 2020, right? Like if you were in Q2 2020 and you still believed in the market, there's some really, really interesting things to do then. After that, people started jumping back in, right? Rates were super low. The economy was propped up by trillions of dollars of Fed printing money. And like it felt like the world was on fire again. I mean, Q4 felt like things were on fire again. Q1 things are on fire. And now there's, in crazy competition. But we did 4 deals kind of in that Q2 period. So we were able to transact on 4 transactions. And one of them, interestingly, and I think at the time, we really had to have a lot of conviction around this investment. And it was interesting how much demand we had from investors, but we did an office deal in the heart of Las Vegas, Nevada. Now, you might be asking yourself, what idiot invested in an office deal in the heart of Las Vegas, Nevada, as COVID is like full steam? I mean, you've got to be a
Full lockdown
fool,
mode.
right? You got to be a total fool. And yet the reason we weren't a total fool and the reason that it's proven out that we weren't a total fool is we did a deal with NV Energy as the anchor tenant. NV Energy wasn't going anywhere. We knew that NV Energy wasn't going anywhere. They had 9 years left on their lease term and we had great debt. And so when we looked at that transaction and we looked at the risk reward profile of it, we came back with it doesn't matter what happens with COVID, right? Like it really in that instance, I think COVID's had a huge impact, in a lot of lives. So I'm not downplaying that, but from a real estate perspective on that investment, And we had a ton of demand for that, right? Because I think investors saw I can get a really, really good cash on cash yield. I have, a fantastic tenant. And I don't think COVID is going to be what's driving a recession if we have one 8 to 9 years from now. So, we also bought a medical office building. So we bought a medical office building in Lubbock, Texas, of all places, in the heart of the pandemic. And that deal was a very similar analysis, right? We had a hospital system as the tenant. It is a strategic location for that hospital system, strong yields. And that was another deal that we did kind of in the heart of COVID. And then we bought two multifamily value add properties in Dallas that we got a great deal on. I think we that those are the two deals we really truly got a COVID discount on. So, I'd say it was interesting. There was demand for office, although the right type of office. There's been a lot of demand for multifamily. We've also been doing some multifamily developments. So we believe that in markets that are being, hard hit, like New York, like Los Angeles, they're going to come back. So we fundamentally believe that people will return to cities. Now, there's people who were planning to move out of the city, and this certainly accelerated their move, right? Young adults who want to go have kids, they're not going to go, if they were planning on leaving Manhattan 24 months from now, they've now left Manhattan, right? They've made that decision sooner, and that's going to impact the market for a while. But, by 2023, we think LA is going to be back. We think San Francisco is going to be back. We think New York City is going to be back. And so we've been making some investments where they're deliveries in those timeframes, right? I think we did one development deal pre-COVID. And then post-COVID, we've now done 4 development deals, and we've got a handful of others in the pipeline. So we were not big believers in development because we're very worried about the recession, right? We thought that there was going to be a recession. We didn't know what was going to cause it. But we didn't want to be delivering into a recessionary period. And when COVID hit, we said, boom, it's time. Because if there are shovel-ready projects, they're going to have challenges, getting the financing. And those that can get the financing, they're going to be delivering in a time period, which we believe is 2023, plus or minus, depending on the market, where there's going to be less competition. And so they're going to outperform. And so we've also seen a lot of demand, alongside that thesis with our investors.
Perfect. Let's hit some of these other ones. So we talked a little bit about asset class. Let's see. Maybe take this one. So I love multifamily, you love multifamily, but if there was one risk out there for multifamily, what is it? And is there a way to mitigate it?
Yeah, I think that it's nonsensical underwriting on exit caps. So, and James, just help me. How sophisticated are your groups typically? Do I need to run through what a cap rate is, what a
No,
market,
no,
like those kinds of things, or?
no, most of the participants here are investors who bought those deals that you saw on the closed deals. So they're buying deals, they're
Great,
syndicating deals, they get it. So you
great.
can go as deep, the deeper, the better.
Great. So I think that it's either you got to get in and out fast, right? Because cap rates are going to move. So if you're doing, value add business plans, it's, do the value add. And if it's an appropriate time to exit at that point in time, you're exiting because we don't know what's going to happen with interest rates and with cap rates. If you're buying sort of longer term holds with fixed rate debt, and we do both of these things, right? We've got sort of opportunistic deals all the way up to slow and steady, do nothing types of transactions because different investors are looking for different things. But I'm worried about the trend on interest rates, right? I'm worried about the trend on interest rates. I'm worried about the increase in taxes that's going to be coming through the Biden administration. And that's going to have an impact on multifamily, right? And I think that what we're seeing a lot of still is that you'll have a deal that we're buying at a 5 cap and the sponsor's modeling to exit at a 5 cap. And like, it makes my stomach turn, because if interest rates continue to move up, you're not going to buy at a 5 cap and exit at a 5 cap. In an ideal world, I'd like to see 100 basis points spread there at least. So 1% between your going in cap rate and your exit cap rate. But I think that that's probably, one of the biggest risks I see in multifamily underwriting today. And in general, I don't know that it's any different than what I'm seeing normally, but, not using appropriate vacancy assumptions, right? I see a lot of this property is going to stay 97% occupied. Properties typically don't stay 97% occupied, right? Even if you're the best operator in an amazing market, like there's still natural turnover. It still takes time to redo the carpet and the paint and all of those kinds of things. I think that it is very submarket by submarket today. So one thing that we learned during COVID is COVID was not a national, it was a national event, but it didn't have a national impact. And what I mean by that is you think about a market like Salt Lake City, who actually had employment growth year over year through December 2020. So I don't have the Q1 stats, but from January 2020 to December 2020, Salt Lake City had employment growth. You contrast that with a market like, northern New Jersey, which lost 10% of the jobs in the submarket. This was not a national recession or a national sort of impact. So I think that question is very delineated into market by market, right? And really deeply understanding the deliveries in a market and the supply and demand characteristics of specific markets. So, we're bullish on the same markets that, I would say everyone is bullish on markets like Phoenix and Dallas and Raleigh and Charlotte. From a state perspective, we like markets with low or no income taxes, Washington and Texas and Florida. Unsurprisingly, these are the markets where there's job growth and there's population growth. And so when you have job growth and you have population growth, you have a better shot at hitting those increased rents, right? If you're modeling for 2% rent growth or 3% rent growth. That being said, we just bought a deal outside of Detroit, Michigan, in Lake Orion, Michigan. And we like that deal a lot because of the supply and demand fundamental. There's no one really building there, right? There's no new affordable housing stock that can conceivably come onto the market there, especially given what's going on with the timber prices, right? And building based on what's going on with timber prices and lumber prices, or what's been going on. They actually dropped a bit this week. So I go back to I'm open to investing in real estate in almost any market in the country if it's the right time and the right place. So that's a very hyper local question. But I think on the underwriting side, the biggest risks I'm seeing are people using unrealistic exit cap rates and unrealistic, vacancy and bad debt assumptions.
All right. So I'm gonna move over to the next sort of set of questions. So we got a lot of questions. So I just want to try to give enough time to each section. So now this is more sort of around investors, and you talked about investors expecting a lower return going forward, and so maybe touch on what, when you guys take a deal out to market, what are you projecting, let's say, for a multifamily deal right now in terms of cash on cash, IRR? What type of projections are you making right now?
So it totally depends. And if people want, go to realtymogul.com, sign up for a user account. It's free, and you can, see the transactions that are up there. I think there's 10 or so deals up right now. So you can go, feel free to dig in. You don't have to invest. It's free. There's no commitment or anything of that nature. Not a sales pitch, but you can kind of go see for yourself. On this question around investors' return expectations, it totally depends. We have 220,000 members of Realty Mogul today, not investors, but members that are, seeing deals and actively running through deals. And some of them are more conservative, right? They are open to 8% cash on cash and a 12% IRR, which is more of the stable, steady multifamily with fixed rate debt. Others of them are very opportunistic. They want to buy into an apartment, development, and those tend to be kind of in the 17 to 20% IRR ranges. I'll just quote you an IRR so you can kind of compare. Obviously, there's equity multiples and cash on cash as well, and you can see them on, on our website. But I'd say that's kind of the range. I'd say we post things on Realty Mogul between a 12 IRR and a 20 IRR, and your value add multifamily deals are going to be somewhere in the middle there. Call it 14 to 16 is kind of where they've been coming in on a projected return basis. And that product is a different type of investor, right? For an investor who really wants to take a lot of risk, development might be the right fit. For an investor who, doesn't want to take a lot of risk, fixed rate debt, majority of your IRR being a derivation of cash flow is a lot safer, right? And then value add multifamily, I'd say, is somewhere in the middle. But even in value add multifamily, you have a lot of variance, right? We might do a value add multifamily deal where you're investing $5,000 a unit, paint, carpet, maybe new cabinets, versus another deal where maybe it's $40,000 a unit, right? And it's a total gut renovation. I mean, the thing was a dump before it got bought, and now it, is a B plus asset. So there's a different level of risk there. There's a different level of construction risk. There's a different level of market risk. There's a different level of sponsorship risk. But I'd say in general, you're looking at 12 to 20% projected IRRs.
Okay, great. is Henry asked around sort of when you guys, obviously you get a lot of transactions, a lot of deal flow. Once you start underwriting these deals, is there anything that you've changed? We talked about residual cap rate, but is there anything that you've changed sort of post-COVID?
Yeah, so we're constantly making adjustments, and again, a lot of it is market by market. So we spend a lot of money on data, CoStar, Axiometrics. We're constantly looking at Marcus and Millitrap data, CBRE data. I mean, we've got a fairly sizable underwriting and analytical team now. So it depends. So some of it is submarket by submarket. In general, it's what I talked about, which is exit cap rates, bad debt, and vacancy. Those are kind of the big ones. The other one that I'm a big stickler on is insurance. And I'm changing my tune actually. I think that the federal government is going to have to get involved in insurance because of the impacts of climate changes and all of these things. It's just going to make, I think eventually the federal government gets involved. And so maybe that's less of an impact, but I'm really worried about, insurance, being grown at 2 or 3% a year. Like that's just not where insurance rates have moved. And this was a pre-COVID thing, but I'm sharing it, just generally, but it's bad debt, it's vacancy, and it's submarket by submarket. I mean, now having the data on 16,000 apartment units that we, have active reporting on a quarterly basis, in addition to the CoStar data and the Axiometrics data and some of the other proprietary data sources that we look at, this is really a market by market question outside of the bad debt, vacancy, and exit cap rates.
So you guys have a pretty good subset. I know NMHC, they do sort of their collection data. Is your 16,000 units doing the same as the national NMHC data? I'm just going to ask real quick.
What's the latest on? I'll give you our stats. So
Yeah.
pre-COVID, we were running 98% across the portfolio. Average post-COVID was 95, 96.
Okay.
Now that changes month to month. It changes quarter to quarter. We run it on a quarterly basis. I don't have the Q1 numbers yet. I'll get them in probably 25 days, maybe 30 days.
Right.
But we were running about 2% less on collections than we were in a pre-COVID world. But every property is different again, right? Like I think about our portfolio in Brooklyn. So I'd say our worst performing, or one of our worst performing assets, is in Brooklyn, where collections have been horrific. And I think that part of that is political. And I'm not here to make a bunch of political statements, Democrat, Republic. I appreciate everyone and their points of view, and I have friends on both sides of the aisle. But I do think that you see an impact in real estate, right? You see an impact in population growth. You see an impact on how much money people keep in their pockets and what they can spend on rents and other discretionary items. And New York's been very tough. New York effectively came out in the beginning of the pandemic and said, don't pay your rent, in more words than that. But that was sort of the messaging, and that hurt. And so does that mean that I'll never invest in New York again? No, I actually think there's interesting opportunities in New York because so much capital has left New York, right? And because rent, values have actually come down in New York. I think that New York's really interesting. And it's funny, we'd had a strategic conversation internally, and we said, okay, January 2022, we're going to go hard New York. I think we're going to miss the window, to be honest. I'm already seeing rents start to pop back up in New York. I'm already starting to hear, anecdotally that people are, starting to get back. It feels a lot more vibrant. It feels a lot more, vivacious. And so I don't know. I'm afraid to get in today, but at the same time, I'm now instinctually feeling like 2022 may be too late to get back into New York, but who knows?
How much have values, obviously, if you can't collect rent, have there been any transactions in New York? Does anyone have an estimate on how much values have dropped because of the amount of capital who's left that market? Or, if it's down 20, 30%, is that enough?
I mean, I can tell you, we got a BPO on an asset that we own in Brooklyn, and they told us that it would sell between a 5.5 and a 6 cap. And we're looking at deals in Northwest Arkansas at a 4 cap, or it was a 4.2 cap. So I'm like, that doesn't make sense. Like that's just fear, right? And at one point, that switch is going to be flipped between fear and greed. It hasn't flipped yet, but like, because we're active in so many different geographies, we spend a lot of time talking about, what are we seeing in Boston versus New York versus Northwest Arkansas as an example, versus, Detroit, Cincinnati, St. Louis, Dallas, Austin, San Antonio. I mean, we see so much deal flow, and we're looking at New York right now and going, something doesn't make sense, right? Like people are going to have to pay their rent eventually. You've also got the rent relief bill now, which is going to help. But New York's got other problems, right? They've got a lot of problems around rent control and, old housing stocks. You have to be very careful about what you buy there, particularly with what's going on with rent control. And that was all, pre-COVID impact. But I do think that there's opportunity there. We're not yet ready to jump in again, But I am starting to feel, and it's an agenda item for my one-on-one with our chief investment officer, of like, is 2022 too late? And what data should we be looking at, and how should we be thinking about this? Because I'm not seeing a lot of other places outside of retail and hospitality, which are kind of the obvious ones, where there's a tremendous amount of distress in multifamily, right? And where there are actually sort of deals to be had. A lot of the deals that we're investing in are right down the fairway deals. And I don't have a problem with right down the fairway deals, right? Like if the economics make sense and the underwriting makes sense and the debt makes sense and the operator makes sense, like right down the fairways, that's fine, right? But we also want to find deals where we think there's unique opportunity. And so we're analyzing New York earlier than we were expecting to.
Have you done the hotel to multifamily conversion yet?
So we've probably seen 20 submissions for that business model. We have not.
What
Just haven't
what
found.
usually breaks it for you?
It's usually the operating partner, to be honest.
Okay.
So the challenge here is that there are not that many operating partners that have gone full cycle on that plan, because the
It's
business
so new.
plan is new, or yeah, but it is and it isn't. I think buying distressed hospitality to that, kind of COVID distressed is, but that business plan has been around. We haven't found the right operating partner to do it, and there's been issues, frankly, with design on the hotels that we've seen, right? Where we're looking at them and we're going, would we want to live there, right? Like this doesn't feel, it doesn't have the feel of a home, right? Or an apartment, right? Where people describe as their home. There are these very dated hotels, even when we have vision for what they look like on a renovated basis. Now, I like the strategy. Strategically, I like the strategy. I think that you can end up with a great basis, right? Your price per door on an exit on them is substantially less than your price per door, on a traditional multifamily unit. So conceptually, I have no problem with it. We just haven't found the right operator and the right deal.
And it's 250 square foot units.
Well, I mean, we've done a deal that's micro units,
Yeah.
but a lot of times you'll see like something with a suites, right? Like an Embassy Suites or something like that, where they're larger units. But we did do a micro unit deal in San Diego. So I think that in the right market where there's a real need for affordable housing, and kind of going back to that supply and demand equation that I talked about earlier, like the strategy makes sense. We haven't found the right deal yet.
So James asked, a lot of people on this call, a lot of them are general partners and they raise money from limited partners. And he asked, you mentioned you had 220,000 members who have at least subscribed or at least signed up for Realty Mogul. You don't have to give us all your secrets, but if you were a general partner out there, any tips on increasing their investor database?
I'll give you all my secrets.
Okay, here we go. Get your pen out.
It's hard work, I mean, I remember when I started Realty Mogul in my living room. So if we just go back to kind of, inception days, 2012, I'm in my living room. And every investor that would sign up on our website, I would personally call. And I wouldn't tell them that I was the CEO, right? I wouldn't say, I'm Jilliene, the CEO. I would just say, hi, calling from Realty Mogul, because, I think I was embarrassed to be the CEO calling on investors. And so I would introduce them to the website, and I probably called on the first, I don't know, 5,000 plus investors, right? Just to say hello and introduce the platform. And that was hard work, right? And then I got to hire a team and train a team and build a network. And then we spent millions and millions and millions of dollars, right? I mean, that's really the truth, is we spent a lot of money on acquiring investors, and then we've tried to treat them very well, right? And do what we say we're going to do, communicate when good things happen, and communicate when bad things happen, be honest, have a deep culture and value system, right? Sleep well at night is our number one cultural value, and that sort of permeates through everything that we do. And we hope that investors can kind of see that. But, the reality is it's just hard work, and you have to treat each investor as an individual, right? Because they are, and they want personalized attention. And, thankfully now we've got a big team of people who, can communicate with those investors, and who I've trained personally, and they go through kind of the Realty Mogul boot camp to get trained up before they get on, any calls with an investor, to make sure that, they're aligned with our culture and they know what we're comfortable with. But, in the early days, it was every investor I would call. We treat repeat investors like gold. We communicate, we do everything in our power to get quarterly reports out on time. One thing that really pisses investors off is if your K1s are late. So for those of you who are GPs, like just deliver your K1s on time and you'll get like a huge pat on the back. It seems so simple.
Get off this call, deliver the K1 right now. It's March 31st.
I mean, if you haven't delivered it yet, you're late, right? Not early. But yeah, it's just, treat people how you want to be treated. At the end of the day, it comes down to the golden rule, and be honest when bad things happen. I mean, I'd love to be able to, I was gonna say stand here, but sit here at home and tell you that everything we've done has been perfect and every deal's been perfect. It's just not the truth, right? But when a deal does not go well, we don't send a blind email. Like my team picks up the phone. I pick up the phone personally and I say like, "Hey, I have bad news to deliver." Right? And you treat every interaction as a sacred interaction that hopefully you'll get another chance, right? And you'll get another shot at it. And I can't tell you, it's funny, we're a technology company and there's a lot of people who don't want to talk to us, right? Like they're investing with us because they don't want to talk to a human being. But when push comes to shove, if you choose to pick up the phone instead of sending an email, it makes a big difference. And so I'd say we're a technology company with a human touch. And that's also led to a lot of word of mouth, right? And investors telling their friends. And it's very cool. We've got a lot of multi-generational families investing with us, where the father invests, the son invests, the aunt invests, and like that's really, really cool.
And they can all invest different amounts in different deals and everything, right? So
Yeah.
I mean, we touched on some of this. I mean, and maybe Jacob asked this question around, and I don't know if you guys have done this, is you have, accredited investors maybe investing their own money, but then do you work with like larger private equity groups or family offices, and then do they invest in deals? Have you guys worked with those groups at all?
So the majority of our capital is tried and true high net worth accredited investors.
Okay.
We have invested with private equity. Alongside private equity, we do have family offices that are investing on the platform, but really the majority is high net worth accredited investors. And I think that there's a lot of differences if you're a GP right now. We sort of act like a private equity firm in some respects, because if we're going to be if the investors from Realty Mogul are going to be the majority equity, we will negotiate certain control rights the same way that a private equity firm would, right? And so on an aggregated basis, it's going to look a little bit differently. But like if I was just a GP, right, and I didn't run the business that we run, like accredited investors, in my opinion, are the single best investor, right? Because you're going to have typically, if you set expectations, you're going to have patient capital. You're going to have investors who aren't going to negotiate on every individual point because they're not the majority equity on the transaction. They're not going to have sort of those bargaining rights. Now, again, we negate that a bit, frankly, on our platform, because just investor protection is so important to us, and we have certain controls and rights and requirements that we mandate when we're working with GPs. But I believed when I started the company, and continue to believe, that going direct to the accredited investor is the best way to build the business, because you also have diversity of capital, right? Like one of the things that I saw coming up through the banking world was like the incredible impact that Lehman Brothers, one firm, had on our entire financial institution. And there are, a lot of folks in the financial world who were taken down because of their concentration to Lehman Brothers. So it wasn't actually their firm. It was just a poor decision to not diversify. And I think that the same thing can happen if you've got, one private equity firm that you do all your deals with, or one family office that you do all your deals with. Now, don't get me wrong. If you're just getting started, you take concentration risk and you build the business. But I don't ever worry that overnight we're going to suddenly lose 220,000 investors. It's not going to happen. And so that's not a risk that keeps me up at night.
This question's not on there, but it's my question. When the 220,000, if you had to pick, let's say, either 3 states or 3 cities, is there a concentration of investors in a particular state or city?
Yeah, it's in this order: California, New York, Washington, Texas are the states. We're heavy LA. We were born in LA, so we're kind of a tried and true LA company. We got a lot of early tech press. That drove a lot of momentum. Microsoft is an investor in the parent company, so we had a lot of interaction with Microsoft early. So we got a lot of investors out of Seattle. So that kind of drove the Washington and Seattle contingent. And then New York and Texas just are, unsurprisingly, there's high concentrations of accredited investors, and we spent a lot of digital advertising money there.
And I don't know if you saw this. I mean, one of the many companies moving to Austin was I think, competitor of you guys. And I know you guys are based in LA, but any thoughts around coming to Texas?
Look, we have team members in Texas.
Yeah.
I don't think we're going to move our headquarters. Although it's weird, like our headquarters is remote, right? I mean, I've
Everybody's
got
remote.
team
Yeah.
members now, and I think we're up to 12 states. I have to double check me on that because we just hired someone else today in another state. So I think we have team members in 12 states now. We're boots on the ground on every property. So someone from the Realty Mogul team walks, every property that gets posted on the Realty Mogul platform. So that's been a requirement of ours from the beginning, which has been very different from some of our competitive set and just something that I've always been a stickler about. Like I don't know how to be comfortable investing in real estate without, kicking the dirt, right? And that kind of goes back to are we a technology company or a finance company or what are we? So we're somewhere in the middle, but we pick up the phone and we walk on the dirt. So that makes us, not a tech company, but we raise all of our capital online. So that makes us a tech company. But, I don't see us moving headquarters, but frankly, we're not really headquartered anywhere anymore. I mean, COVID has pushed the proliferation of remote work. And for us, it's really beneficial because if we're going to do a deal in, Dallas, I call my guy in Dallas and he can be at that property same day, and we're going to do a deal in Connecticut and I call my guy in Connecticut and he can be at the property same day. Or I call, the woman working for us in Nashville or the woman working for us in Columbus, so it works very well to have a real estate company when we're doing deals in so many different markets.
All right. So we've touched on commercial real estate market. We touched on multifamily. We've touched on investors. Now I want to dig in a little bit on Realty Mogul because I think some people get it and other people still don't really know what you do. So I'm going to ask you questions. Some of these are going to be tough. So here we go. All right. And there's probably 10, 15 questions on here. So if you want to spend a minute or two on each one, that'd be great. So process for vetting deals.
Sure. So maybe let me start at the top. So
Yeah.
realtymogul.com is a technology platform. And on that technology platform, we post investment opportunities from sponsors. So sponsors come to the platform, GPs, sponsors is just another word for GPs. GPs submit transactions onto our website. And from there, they go through an automated screening process. So we built some technology to automatically screen them. And then once they're pre-approved through the automatic screening, they'll get assigned to a deal team. Starts with an underwriter. And then from there, we will run background checks, criminal checks, reference checks. We'll go through the historical track record of the sponsor. We'll underwrite the deal from scratch. So we do what's called zero-based underwriting, where we'll underwrite the deal from scratch. We'll put our own assumptions on top of it. We'll do a legal review and we'll go visit the property. So that's kind of from a high level, what we do to vet deals. And we'll see a couple thousand transactions submitted. As I mentioned, since inception, we've seen 30,000 transactions submitted and we've done about 300. Typically, we're looking for sponsors who have done over 200 million in transaction volume. So it's sponsors with over 200 million in AUM. But we've got clients, on the sponsor side that have done 4 billion of AUM. So, we've got some very large clients and some, more emerging clients, if you will. We disclose all of that on the website. And we'll also dig into the debt as part of the underwriting, right? And that's going back to your earlier, question about this week, actually, if you were on my investment committee meetings this week, I was really hard on the team and I tend to be, sweet, but hard. And I was hard because I was seeing all of these, agency loans and the sponsors were saying that they're going to close at, 325 or 330%, 3.3%, 3.25%. And I was like, team, I don't want to see anything under 360 right now, right? Like on Freddie and Fannie financing. And James, maybe you have a different perspective there, but that's another thing is we have to really watch where the debt markets are moving because cap rates have compressed so much. We are finding that the models are more sensitive, right? There's not as much room for error in those models. And so it's really important to me that we get the debt assumptions right. And there was a question, what do I mean by sponsors? I mean GPs. So GPs, typically GPs who have over 200 or 250 million of assets under management will submit transactions onto our website. They're then assigned to a deal team. Our deal team goes through the underwriting process. If it's a deal that we think, is going to be interesting, we'll provide them with a legal document, which is, how to post their transaction on our technology platform. And then we go from there.
That's perfect. And I mean, I think that everyone should go through that process for any deal. So you've got it down to a science, which is great. Edward asked sort of, there was probably, it probably started as a small field and then it got to a really big field of crowdfunding platforms. And then I feel like it's consolidated a little bit. So maybe talk about how yours is different, because I think for a lot of people, they see yours and then they might see another one and they're accredited investors and they sign up, but they don't, how is it different? I guess let's focus there.
Yeah, they're all a little nuanced.
Okay.
There's some platforms that they only have REITs, right? Where you're buying into a pooled vehicle or a fund. There are some platforms where they only have investments in individual properties. So you can buy an individual apartment, office, retail, self-storage, etc. We have both. So we have two REITs. One's focused on income, one's focused on growth. And we also have individual property investments. So if you want to sort of set it and forget it and invest in the REITs and not make deal by deal decisions, you can do that. If you want to decide on a deal by deal basis, you can also do that. I think the other way that we're fundamentally different than some of our peer set is that we truly stay involved for the life of the transaction. So there was two directions to go, I think, as we were building Realty Mogul. Direction one was truly be a technology company, build technology that the GP can use to interact with the investor, have no controls over, the operating agreement and what the GP can do. And there was another path, which was act more like a private equity firm. So if the investors from Realty Mogul are going to be the majority equity, put controls in place for their protection, stay involved for the life of the transaction, do distributions, distribute tax documents, distribute quarterly reports, review the quarterly reports, have a perspective on the quarterly reports, step in if there's a problem, have the right to force a sale if, somebody does something that they shouldn't be doing. And we took the latter path, right? And we took the latter path because I started Realty Mogul because I wanted to help my family invest family capital in real estate, right? And so if I'm investing money out of, my family trust, do I want to invest it with a platform that's a free for all, or do I want to invest it with a platform where they have some controls over the long term, right? And don't get me wrong, I think that there's good deals on all platforms. I don't have anything negative to say about any of the platforms. I think that if you're an investor who has a tremendous amount of time, a tremendous amount of knowledge, there's no problem with going with sort of the self-serve platforms, right? Where they don't stay involved for the life of the transaction and they're truly just technology platforms where GPs can then interact with the investors. But most investors, this isn't their full-time job, right? They have other full-time jobs. And so I personally like that we stay involved for the life of the transaction. I like that when a deal sells, we will do our own sale analysis and we'll actually make sure that the money moved in the right direction and did what it was supposed to do, and that we actually have the documents to do that. I require in all of our quarterly reportings that we get a general ledger. Normal investors do not ask for a general ledger. Now, how often do we actually have to look at the general ledger? Almost never. Have we looked at the general ledger? Yes. Have we found problems? Yes. Right? And am I proud of that? No. Right? I wish that there weren't problems and that everything was perfect, but one of our other core values is details matter. And so what that means is that we're going to dig, right? If we find something that looks off or a number looks off, not every number every quarter, right? But definitely when we do a sale, right? Definitely when we do a sale. And I hate to say this, but there have been multiple times where the sale analysis done by a third party sponsor was incorrect, not in poor intention, not because they meant to do it incorrectly, right? But because this stuff is complicated, right? And waterfalls look different. And, for better or worse, we've done 300 transactions and I don't think any of our sponsors have done that many transactions. And I feel like we've seen a lot. And so we know what to look for. My head of asset management has been with me for over 6 years. He's seen, a lot, right? And he's the guy who manages the team now that's doing this work. And it's funny, we had a deal recently where the sponsor sent us the sale analysis and they were underpaying themselves by $1 million. And we went back to them and we said, look, investor protection is one of our core values, but higher than that core value, and we stack rank all of our core values, is sleep well at night. And you're underpaying yourself by $1 million, and that's not going to allow us to sleep well at night. And here's our analysis, right? And so we actually took $1 million from the investors to the sponsor because that's what the document said should be done. that's what was agreed to, right? And it wasn't fair with us having found that sponsor mistake for them not to get the benefit of that. Now, we've also had transactions that were the flip of that, right? And so we kind of it's important to us, right? And I would say that's fundamentally the difference. Um, and I'm proud of that. And it's a lot more work and it's a lot more money and it's not as profitable. And at the same time, I don't know how to run a business any other way.
How many deals do you guys currently have going right now, roughly, if you had to estimate?
Going
As
meaning
in, like,
live on the platform or
no,
that we're asset managing?
in asset management, just roughly, is it 100? Is
It's
it?
a 100 plus or minus.
Oh, wow. Okay.
Yeah, I think it was 96 the last count, but we closed 10 this quarter. So I don't exactly have the exact number, but it's somewhere around 100.
Okay. All right. Wow.
Yeah.
All right. Todd asked if you've got traditional sources of LP equity versus going on the platform and raising money. I mean, you mentioned, these guys have done 200 million to 4 billion in deals. They obviously have raised money other ways. Why are they coming to your platform or crowdfunding platform just in general?
Yeah, I mean, normally it's so they can scale, right? So we'll find sponsors who will do business with us before they run out of sort of their own friends and family capital because they want a relationship with us for them to scale. And on a lot of our deals, our GPs or our sponsors, they'll go raise a couple $1 million from friends and family, and they'll raise, $5 million or $10 million in the Realty Mogul platform, and those investors will co-invest together. So we don't require that we're the only equity. We're flexible in that perspective, but I think it's so that they can scale, right? And so that they've got diversity of capital and they don't have one capital partner. If you have an unlimited source of accredited investors or an unlimited source of equity, I wouldn't use a crowdfunding platform. There's just no need to. But I think that most of the sponsors that we work with, this is their careers, right? This is their profession. They're building businesses and they want diverse sources of equity to be able to scale.
This is getting into the nuances because I've seen it happen when different general partners partner together on a deal. Is, let's say I raise half the money and I have my investors, you raise half the money, you have your investors. Do all those investors get thrown into one bucket now, or do you always keep control of your investors? Does that make sense?
It depends on the deal.
Okay. All
I
right.
don't, it depends on the deal. So and look, I think because it depends on the deal, it's really important if anyone is considering, investing through Realty Mogul, like please go read the deal docs. Please go read, the specific risk factors. Please go read the specific nuance of the deal. Because again, every deal's different, right? And there are some deals where 90% of the equity is coming from the Realty Mogul platform. There's some deals where 15% of the equity is coming from the Realty Mogul platform, and there's going to be different controls based on that. And we're super transparent about it. You can find it all on our website, but every deal is truly different.
Okay. Satish asks, are your raises 506B or 506C? I'm guessing C, but
We actually have
or what do
done
you guys
both.
use? Okay. All
We've
right.
done both, and legally we can do both. I'd say more often than not, they're C's
Okay.
for two reasons. One, we provide GPs with accreditation verification on every investor if it's a C. So a lot of GPs want that so that they can sleep well at night. And then two, we've got a marketing package that helps sponsors to raise more capital for their transactions. And the only way you can execute on that marketing package is if it's a 506C.
Gotcha. Um, this is interesting. I don't really know if there's an answer on this, but Derek asks, is there any technology, your technology company, that you're achieving, let's say in multifamily or utilizing with your general partner besides raising the capital, right? Is there any other technology that you're helping the general partner use, or whether it's at the property or just in another way, whether it's smart home, whether it's any of these other things? Any comments on that?
Yeah, I find most things in life are relatively simple. They're just hard sometimes, right?
Okay.
And so this one is an interesting one, and we saw this play out during COVID. And I'm really pushing hard. We can't we don't mandate the operations on a day-to-day basis with most of our GPs unless there's like a real problem. Like if I'm up in your business day to day, there's a real problem, right? So in general, we don't mandate sort of the day to day, but I would say the number one thing that I'm trying to push right now is getting your renters on direct debit. So when you direct debit from them and you've got authorization to direct debit, the collections are meaningfully different in the time range, right? So if you can collect, for example, if you can get 80, 90% of your property on direct debit, and on the first of the month, you've already collected 80, 90% of the rent. This is in more like workforce housing kind of stuff, not class A kind of stuff. That is meaningfully different than an operator who's collecting 80% of their rent on day 15, right? Like and it's particularly meaningfully different because you have the same quantity of property management staff. But now, instead of spending the first 15 days of every month on collections, they're spending it on leasing and, creating a great tenant experience and tenant events and all the things that, make things go. So that's a big one. I actually did a podcast today with Chris Aiello, who's the CEO of Six Peak, which is one of the largest co-living operators. And 100% of their tenants are on direct debit. It's just mandated. Like you can't live in their co-living buildings without being on direct debit. And I think it's made a big difference for co-living during COVID. And it's something that, almost all of our renters have technology, right? They have cell phones, they have bank accounts, maybe not 100%, but a good majority of them. And so that's the big technology push. It's not new, fancy, sexy, slick technology. It's like stupid, simple, basic. But that's the one. If I was going to put, a spotlight on one, and then the other is just remote leasing. We've been very successful with remote leasing. That's here to stay. One of our properties, they ran a decent test where they did, their remote leasing stats versus their, in-person leasing stats, and the remote leasing stats beat it. And that's, like irrespective of COVID, I think remote leasing and self-guided tours is here to stay.
All right. Albert asked around, so we talked about the GP a bunch. From the LP perspective, if you could narrow it down, obviously deal flow, but anything else, oversight, what else would you say sort of from LP perspective Realty Mogul provides?
Yeah, I mean, it's definitely deal flow, right? I mean, we have teams all over the country that are sourcing deal flow. We have teams that are underwriting transactions, and I think it's the oversight, right? I mean, it's someone who's going to run the analysis when the sale analysis, right? And it's someone who's going to, raise the red flag if there's something that looks off. And I think that it can help people, to sleep well at night. But look, if you have a steady source of deal flow with sponsors that you like and trust, like you don't have to use us, right? And you can certainly do deals with those sponsors. I find that people forget to diversify sometimes in real estate in private syndications, right? So where you wouldn't put 100% of your money with one CEO in a public company, I do find people will invest all of their sort of private syndication allocation with one sponsor or one GP. And I don't think that's prudent. Right. And I don't know what that diversification is for, someone individually. You kind of have to make your own risk reward trade off there. But I would like to see investors carve off kind of their allocation to private syndications or real estate. And then within that, say, I want to get exposure to 10 GPs in 10 markets, or I really believe in one market, but get an exposure to 2 or 3 GPs. Right. And I think that there's a lot of risk to having 100% of your allocation with one GP. So if you have the ability to find that deal flow elsewhere, amazing. All the power to you. If you don't, we help investors do that.
So, I mean, in most private syndications, you're looking at 50, 75, 100,000 per deal. And so that's why it's sometimes harder to diversify across 10 deals quickly. Yeah. Right. So on the Realty Mogul, what sort of typical minimums to invest in a deal?
So on the private syndication individual deals, it's typically $25,000 to $35,000, and then our REITs are $5,000. So our REITs are very easy to get access to, very easy to start with us. It's funny, we debated a lot internally around, do we make the minimum $5,000, do we make the minimum $25,000 in the REITs? And we had an investor who started at $5,000 with us and then invested $1 million with us. And we're like, okay, we'll keep it at $5,000, right? He just watched, did I get my distributions? What's the report? What's the communication? Did I get my tax stocks on time? Right? I told you.
Got to get that K1 out.
About that. Those are actually 1099s. So
they're
a little bit different.
Yeah,
but
sorry.
The private placement deals have K1s.
All right. I think we've touched on, I like this. Nicholas asks, we talked about the value proposition, whether it's GP or LP. Has it evolved from when you started to now? Does that make sense?
Look, when we started, we were doing residential fix and flip deals. So we had no investors on the platform. Our average raise was like $150,000. Our average today is like 7 or 8 million. So, that goes back to kind of growing that investor base. I really detest the residential fix and flip business now. Having
Okay.
having grown a company in that space, we shut down that business in 2015, just like at the end of 2015. Honestly, we shut it down because I was worried that the market was going to implode, and I didn't want to be caught holding a bunch of residential, distressed residential assets in a downturn. I was totally wrong on the timing, but I still don't like that business. So look, our product offering has certainly changed. That's where we started. We also were in the lending business for a while, and we realized that we weren't the best lenders, right? There's so many lenders out there. It's such a commodity. So we got out of the lending business, and we've always been the best at joint venture equity, right? And now we're hyper focused on joint venture equity. We also do preferred equity, but just equity. We're an equity shop and an equity platform. And I think that that's evolved, right? We tried to be too many things to too many people when we started, which is kind of the classic, startup screw up, and we did it, and we lived to tell about it, and we came out the other side. And today, we're really a tried and true equity shop where, investors and GPs alike can go to fill, that niche in their portfolio.
All right. I'm trying to see if there's anything. I'll wrap this crowdfunding Realty Mogul section with biggest advancement in real estate fintech that you see happening in the next 5 years. I didn't
Can
say
I
they were
go
easy
10?
questions. Oh,
Can
you
I
can
go
go
10?
10. Absolutely.
Okay.
Yeah, just change the question right now.
It's got to be blockchain, right? Like, but it might even take 20.
Okay.
I mean, like, I wish that it was going to be 5 because it's so nonsensical for it not to be on blockchain, and also like actually having, you know, title where you can actually pull title digitally, like all on blockchain, and actually having escrow on blockchain. Like, it's crazy the way that real estate deals are done now. And maybe this is more, honestly, it's probably more so on the single family side than it is the multifamily side. Just because of the sheer volume of transaction flow on the single family side. But it is nonsensical that this has not moved to blockchain, and it should, and it will, and it's just going to take a long time for users to adopt.
Right. Okay. Well, I
But don't
definitely.
quote me on that. Don't make crazy investments on it. And if you lose all your money, don't blame me. So I don't know.
So I'm just gonna. I'm gonna.
Oh, geez. Come on.
Oh.
I didn't know that I needed everyone to sign an NDA to just show up tonight.
So I wanted just to wrap with a couple more questions, if you have a minute, on just sort of your advice, and you can pick and choose from these. Let's just start with this guy. Worst investment, and what did you learn from it, is Aaron's question.
Very simple. Hospitality, and it's the worst risk-adjusted return in real estate, if you ask me. And I don't think we'll ever make another hospitality investment.
All right, that was easy. What keeps you up at night? Because obviously you do a lot. So
people. At the end of the day, it's always people, right? And people in a nice way, and people in a not nice way, right? People in a nice way around, like, how can I create unique opportunities for my team? How can I make sure investors are being treated well? Why does it take us over 24 hours to respond to an email? I mean, like how you treat people, right? I think that's what keeps me up at night. And right now I'm trying to figure out strategically where we move with rates. Like, rates are moving up much faster than I thought that they would. And yet, this is a weird one, but and yet interest rates on like office and retail are actually coming down because there's starting to be more competition there now that lenders are jumping back in that market in a post-COVID world. So that one's been like mind-boggling me a lot. I've been thinking about like what's the right strategy in this really funky environment. I think in office and retail, there's going to be opportunity, and we didn't really talk about commercial at all. So I don't know if the whole most of the folks on the line are really multifamily, but I think there's going to be some interesting opportunities in office and retail as interest rates come down and lenders are in the market, and before cap rates adjust, before cap rates catch up. We have the opposite problem in multifamily, right? Where interest rates are going up, and yet cap rates still seemingly are either staying the same or going down. So it's the opposite problem. But that's not really what keeps me up at night. What really keeps me up at night is people, right? My family, my employees, my team, our investors, and the impact that we're having on people's lives.
Vincent asks, biggest challenge right now.
This is today or in the past?
Your choice. You can take it right now. Biggest current challenge. I'll modify the question. Biggest current
I was gonna
challenge.
go past.
Okay. All right. Fast. You can take whatever's the
Look,
easiest
my,
for
my
you.
biggest current challenge, honestly, is it goes back to people, but it's we're insanely busy. We have more business than we know what to do with, and we're turning business away because I don't have a big enough team to process it with our standards. Right? I shared kind of our core values. One of them is details matter, and so it's hiring. I mean, I am on the phone all day long trying to hire great people, interviewing great people. I sort of break away for investment committee in our pipeline meetings. And other than that, like it's hiring, it's training, it's hiring, it's training. And that's probably my biggest challenge right now. I think that my historical biggest challenge was learning how to be a CEO. I started the company. I was in my 20s. I was a baby. I knew nothing about nothing. I made every mistake in the book. I made myself sick and ill over it. And I think I've now come out the other side, with sort of the Malcolm Gladwell, do anything for 10,000 hours and you're sort of figure it out. But that evolution was definitely my biggest challenge, just in general of running the company.
On those two things, how does someone shortcut not doing 10,000 hours in those shoes if you had one tip, either one, whether it's hiring and training or learning to be a CEO?
I think that it's assume the best of intentions and be patient.
Okay.
I
Patience.
really
Yeah.
lacked patience in my youth, and I'm still young, right? So like sounds ridiculous to say that, but I really lacked patience. I wanted to go faster. I wanted to move faster, and because of that, I didn't assume the best of intentions. And those were probably the two biggest mistakes, high level sort of conceptual mistakes that I made. And I'm like so over that now. Right now, I'm like real estate is a long game, right? And it's a long game. And sure, you can get some quick wins and you can do some value add deals and you can flip out of them quickly, but that's not the name of this game, right? The name of this game is long, it's slow and steady. It's a career, not a job, right? And for me in particular, right, as a founder and as a CEO. So I'm much more patient. I'm not in a rush. I mean, look, if I was in a rush, I wouldn't have just turned down a bunch of deals that we thought were good risk adjusted returns because we just couldn't process them, right? I would have solved for that in a different way. And so
No, that's perfect. I did want to touch on this. Kay asked, how did you feel coming into, uh, she's calling a male dominated industry of real estate, and any advice you would give to any females out there in the industry?
completely ignore it and work hard.
Okay. Um, Last one, just advice for anyone who's getting started in multifamily, whether general partner, limited partner. You've talked with all these people. You called 5,000 people who signed up for your platform. And you've talked to a ton of general partners. So we'll wrap with this. Any advice?
I guess
Final
I don't know
advice.
if
Yeah.
this question was this question from a GP or an LP, or we don't know.
I don't know,
Okay.
but I think so. What we see is a lot of people will start as LPs. They'll do a couple deals to just see if this is real. They'll put 25,000, 50,000 in a deal, and they find out it's real, and then they jump full feet and they quit their IT job, and now they're a general partner and they're raising money on deals. And so I think, but just from what you've seen from general partners, limited partners, what would be your advice? And you can section it off that way if you want.
So I'm going to totally answer the question in a very different way, which
Okay.
is I lost two people died this week that were near and dear to my heart, and it's a constant reminder, and one that I unfortunately have gotten a lot, around our time on this earth is short, right? And it's about action, right? Like love is an action, right? To love, right? To is an action, to do things, to tell people you love them, to buy them flowers, to take them on a trip, to spend time with them. It's an action. And I share that because I sometimes, people will come to me and they'll say, will you mentor me? Will you help me? And I said, well, what have you done? And they're like, I've talked to this person and I've read books and I've done that and I've done this. And it's like, to get started investing in multifamily, start investing in multifamily, right? And that could be as simple as investing $5,000 in one of our REITs. And I don't say that as a sales pitch. That was not, my linkage between life is important and precious and a sales pitch. But there's many options that you can go to just get in, right? And just get involved. And I'll give you an example. If you are an investor who's interested on the LP side to invest in multifamily, Mogul REIT 2, which is our second REIT, is all multifamily related, and you'll be an investor suddenly in multifamily, and you'll get quarterly reports, and you'll be able to track what's going on, and you'll be able to ask questions, and you'll be able to call my team, and they'll pick up the phone because you're an investor, and you can, spend time with them. And if you want to get involved in the GP side, let me share a different story about action with you, which is the first deal I ever did in real estate was a duplex in Compton. I went in 4.5, 5 years from a duplex in Compton to a $60 million asset in outside of San Francisco, right? Which at the time was sort of the largest asset that we've done. We're going live with a deal on Friday, which is a very cool deal. It's over $100 million transaction in aggregate, right? The Realty Mogul allocation is not $100 million, but it's over $100 million transaction. And I started in 2013 in a duplex in Compton, right? I had a crowbar in the back of the car with another, guy in the business who we were backing. He was the GP, if you will, on that deal. It was a loan, but like that's where I got my start. And so, there's ways to grow in this business, but you have to start, right? And even if you lose money on your first investment, like you're in the game, right? You got an education. You can chalk that up to being your MBA. But life comes back to action, right? And it's how do you want to spend your time and who do you want to spend it with? And again, I just have had like stomach punches this week of a reminder of that, of like what do I want to do in my life? What action do I want to take in my life? And for this person, for Devlina, if that is like, I want to go be a multifamily investor, like go be a multifamily investor, right? What's separating you, it sounds like, is not knowledge, it's fear, right? It's emotions. You need to figure out how to control your emotions and get to this place where you can jump out of that box, right? That you've created for yourself. Usually the boxes we create for ourselves, at least in my experience, right? I create all the boxes for myself. And it's not until I'm ready to take the leap out of that and I'm ready to say, I'm going to go do that. And then it's actually taking the action, right? And I find that that's what separates, the people who are entrepreneurial from those who are not, right? And you don't necessarily have to want to be an entrepreneur. I give a lot of talks at universities, and the first thing that I say to them is entrepreneurship is a disease. If you don't have the disease, don't wish that you had it, right? And find other ways to get the exposure, right? Be a passive investor, invest in REITs, invest in public stocks, whatever it may be. But like if you have that bug and you're like, I want to go be a multi-entrepreneur, there is nothing stopping you but yourself, right? And typically it's fear. And so you have to figure out how to overcome that fear. So I'll tell you how I started it. So before I got I invested in the duplex in Compton, which was the first deal that we ever did for Realty Mogul, which is like, our inception story. I think someone called that Compton. Off the light. Oh, I decided that I needed to understand risk and reward. I was pretty risk averse as a kid. My mother is very risk averse. I don't know if she's on this or not. I sent her the link, so maybe she is. But she's very risk averse. My father is not risk averse. And yet, like, I was pretty risk averse as a kid. And I had someone say to me, Jilliene, you need to go understand that when you take risk and there are consequences, that it's okay that there are consequences. And so I started parking illegally all over Los Angeles. I got 10 parking tickets and I paid every parking ticket. It was a couple $1,000s, it wasn't fun, but like, it was this lesson of like, okay, I took a risk. Something bad happened. I got a parking ticket. I paid the parking ticket. And like I moved on, right? And that is weird, but like that was my psychological challenge. And now I'm not afraid of risk taking anymore, right? Now we have another core value at Realty Mogul, which is take calculated risks, right? So thorough analysis enables us to take the risks that are going to shape our future. That's the cultural value. And if you want to go to our website under careers, there's a whole thing on all of our cultural values, and we really live by them. But I would say that my advice for getting started in multifamily is to deal with your emotions, and that emotion is most likely fear.
Well, I cannot thank you enough, Jilliene, for coming on and sharing your insight. I've listened to a ton of webinars, a ton of podcasts, and I felt like the last hour or so that you gave us has been fabulous. So I greatly appreciate it. And, if you guys could put your comments in the chat, I know Jillian would love to hear them and see them. So I learned a ton. I got a whole page of notes here while you're talking. So I really appreciate it. And, we will let you go from here. So thank you very much.
Fantastic. Have a nice evening, everyone. Take care.
All right. Thanks. Bye. All right. So thanks everyone for staying on. What we're going to do now is go into breakout rooms. And so if you want to update sort of your name, just with sort of name, location, sort of GP, LP, whatever you do, and then maybe your email or phone number, that would work. And then we're going to put guys into breakout rooms here. So just give me 1 minute. And then the first question that we're going to have from the moderators is, what was your biggest takeaway from Jillian interview? And then what will you change because of it? So I'm going to put you guys in the breakout rooms and then just assign you from there. So give me 2 seconds here. All right, there you go.
Currently in Toronto. Hey, James.
Hey guys.
Split time here. Have a portfolio in New Jersey and building up portfolio in Central Florida. Just trying to get to large enough deals to be worthy of James Ng's time. We're not related. He's yeah. So active and passive in multifamily primarily.
Stan, what was, did you have any takeaways from the interview tonight?
Main thing is I'm quite impressed with Jillian. I've been playing with some of these platforms. I've been investing with Fundrise for a couple of years now, and I just signed up as she was talking. I felt that I liked her story, and using this platform, whether it's passive or active, I like to know the story behind the founders, and so main takeaway is that she's somebody to bet on. But I'm going to partner with maybe at some point syndicate deals, but maybe starting with investing through her platform as an initial trial.
Right. Okay. Great. Evan?
How's it going, guys? I'm Evan Haft. I'm actually with InvestNext. It's a software as a service that helps you, kind of manage your investors and process distributions and deliver K1s and everything. I'm kind of new to the product team, so I was glad to be able to join the call and learn so much from the call. She definitely seems very knowledgeable in the space, and we're just here we're kind of growing our platform. We're really trying. Our InvestNext started in Detroit. I'm actually out in Santa Barbara, California, but our goal is to kind of help small to medium-sized firms really modernize their software, and it's really built to scale rather than some of the larger firms that provide investor portals and such. So glad to meet you all, and hopefully I'll hear from you all soon. Anything particular in her comments? I just really liked hearing about the piece regarding the need for more multifamily buildings, because we see it everywhere in all of our communities where, you know, affordable housing can be really difficult to find. And that multifamily is still going to be a great investment, even though, you know, we're in some trying times from the economy